Businesses use life insurance for various reasons, such as protecting the company from the death of a key employee, funding a buy-sell agreement, or providing additional compensation to highly valued employees. Potential impacts of death on a business. While death is a personal tragedy, it can also significantly affect a business, especially small businesses and startups. When advising a client, an insurance agent should understand the client's business structure to provide proper guidance. The death of a key person can pose several issues for a business. Loss of skills. The death of a key person or key employee can cause a business to lose vital skills that are not easily replaced. This can lead to decreased production, lower quality of goods or services, higher expenses, reduced profit margins, and lower revenue. Key persons can include highly skilled craftspeople, entrepreneurial geniuses, influential vice presidents, charismatic salespeople, or engineers with specific expertise. Creditor demands. If a business has significant debt and a key person dies, creditors may become nervous and demand full repayment of loans, especially demand loans, or refuse to extend additional credit. Family interference. If a business owner dies and leaves their interest to a surviving spouse or child, problems can arise if the beneficiary is not capable of or is incompatible with the surviving owners. The beneficiary may also demand an unreasonable price for their share. Equality for family members. In succession planning for a family business, parents often want to treat their children equally, but this doesn't always mean giving them the same inheritance. For example, one child may be interested in taking over the business, while another may not. This requires creative estate planning to ensure both children are treated fairly. Capital gains tax. In Canada, when a taxpayer dies, they are considered to have sold all their property at its fair market value right before death. If the shares of a prosperous business are left to someone other than a surviving spouse, it can result in a significant taxable capital gain. If the estate doesn't have enough money to pay this tax, the executor may be forced to sell some of the shares to cover the tax liability. Business types. The challenges a business faces after the death of an owner or a key employee depend on its structure. Sole proprietorship. This is an unincorporated business owned by a single person. The death of the owner can have a catastrophic impact. From a tax and legal standpoint, the owner and the business are considered the same entity. The business cannot be bought, sold, or bequeathed to another person. Partnerships. A partnership is a business with two or more owners who aim to earn a profit. Partners are jointly and severally liable for the business's debts unless it's a limited partnership. A partnership interest can be bought, sold, or bequeathed upon death, and a significant tax liability can result from a capital gain or loss. Corporations. A corporation is a separate legal entity from its owners, known as shareholders. Shareholders are not personally liable for the business's debts unless they have personally guaranteed them. Similar to partnerships, a significant tax liability can result from the sale or deemed disposition of shares upon death. Key person life insurance. If a business owner or employee is crucial to a company's success, the business can purchase key person life insurance on that individual. If the key person dies, the business receives a tax-free death benefit that can be used to help the company survive by recruiting and training a replacement, making up for lost revenue, covering overhead expenses until the company gets back on its feet. A split-dollar life insurance arrangement is a way to share the costs and benefits of a permanent life insurance policy between two or more parties, such as a key employee and the corporation they work for. For example, the employee might own the death benefit, while the corporation owns the policy's cash value. The Canada Revenue Agency, CRA, believes that the premium allocation for a split-dollar arrangement should reflect the fair market value of each party's interest in the policy. A financial institution may require a business to have a life insurance policy on a key person as a condition for a loan. If the key person dies, the lender receives the portion of the death benefit needed to pay off the debt. In this scenario, the business can deduct the premiums from its business income. Key person life insurance. If a business owner or employee is crucial to a company's success, the business can purchase key person life insurance on that individual. If the key person dies, the business receives a tax-free death benefit that can be used to help the company survive by recruiting and training a replacement, making up for lost revenue, covering overhead expenses until the company gets back on its feet. A split-dollar life insurance arrangement is a way to share the costs and benefits of a permanent life insurance policy between two or more parties, such as a key employee and the corporation they work for. For example, the employee might own the death benefit, while the corporation owns the policy's cash value. The Canada Revenue Agency, CRA, believes that the premium allocation for a split-dollar arrangement should reflect the fair market value of each party's interest in the policy. A financial institution may require a business to have a life insurance policy on a key person as a condition for a loan. If the key person dies, the lender receives the portion of the death benefit needed to pay off the debt. In this scenario, the business can deduct the premiums from its business income. Buy-sell agreements. Many businesses with multiple owners, such as partnerships and private corporations, use a buy-sell agreement to specify what happens if one of the owners dies. A buy-sell agreement typically outlines who is obligated or has the option to buy the deceased owner's interest, the price for the ownership interest, how the purchase will be funded. Buy-sell agreements are important because they protect the surviving business owners, the business, and the deceased owner's family. They offer a guaranteed buyer and value for the business interest and can prevent an unknown person from becoming a joint owner. The most secure way to fund a buy-sell agreement is with life insurance. Two main types of buy-sell agreements are cross-purchase agreements. The surviving owners agree to buy the interest of a deceased owner. Share redemption plans. The corporation itself redeems the shares of the deceased shareholder, which reduces the number of outstanding shares. There are two primary ways to fund a buy-sell agreement with life insurance. Crisscross insurance. Each business owner buys a life insurance policy on the other owners for an amount sufficient to cover their purchase obligation. The premiums are not tax-deductible for either the owners or the business, but the death benefit is tax-free. A disadvantage of this approach is that premiums can vary significantly based on the age and health of each owner. Business-owned insurance. The business buys the insurance policies on the business owners. This method has several advantages over crisscross insurance. The costs are shared equally among the owners, which can be beneficial if the cost to insure each person varies. Owners can easily verify that the premiums are being paid. It may be more cost-effective if the corporation's tax rate is lower than the personal tax rates of the owners. It is generally more efficient and cost-effective for businesses with more than two owners. A private corporation uses its capital dividend account, CDA, to record tax-free amounts it receives, such as a portion of life insurance death benefits. It can then pay these amounts to shareholders as a tax-free capital dividend. When a cross-purchase agreement is funded by corporate-owned insurance, the corporation is typically the beneficiary. When a shareholder dies, the corporation receives the tax-free death benefit, which is credited to its CDA. The surviving shareholders then receive a tax-free capital dividend from the corporation, which they use to purchase the shares from the deceased's estate. In a share redemption plan, the company is the beneficiary of the policies on the shareholders. When a shareholder dies, the company uses the death benefit to redeem the shares from the deceased's estate.